Hello, folks. It is Tuesday, March 7th. It's the evening on the East Coast. The equity markets are closed. Futures markets are open. I'm going to do a quick overview. We had some big moves in the market today, and so we'll take a look at those. I want to start with a little bit of comic relief. I don't follow the mainstream media, but I did a quick look today to see if there were anything that had particularly affected the metals markets, and just came across this. Let me read this to you. So far, the Fed's rate hikes have done little to hurt America's economy. And I read that and I had to laugh out loud. That's a true statement as long as you ignore the housing market, the stock market, and the bond market. So as long as you ignore those three markets, of course, those are the three main markets here in the United States, that's a true statement. So anyway, I got a chuckle out of that, thought I'd share it with you. I think all of the markets were reacting to Fed Chairman Powell's remarks today, where he indicated that interest rates are likely to head higher than the Fed might have been saying in the past, or that people have been expecting. Remember that people are still expecting the Fed pivot. My opinion, and it's just an opinion, the Fed pivot ain't going to happen. So if part of your investing strategy right now is based on the Fed's going to pivot here shortly, I'd find a different strategy. But what do I know? That's just my opinion. What Powell is claiming is that the interest rates are headed higher to fight inflation, and of course that's BS. At this point, the way we're at, basically any spokesperson for a government agency or a three-letter agency here in the United States and probably anywhere in the Western world, take anything they say with a huge grain of salt, and in most cases just reverse it 180 degrees, and you'll be pretty close to the truth, or you'll have a much better beat on the truth than the hot air that's coming out of those spokespeople's mouths. And so let's talk about fighting inflation. What we're looking at here, this is John Williams' website, and one of the free services he provides. He tracks inflation based on the same methodology that the Fed used back in 1980. And so that was before they introduced, what is it? There's six main methods that the BLS uses to make inflation look lower than it actually is. And I understand that recently, just in the last month or so, they've come up with new changes. So they're going to modify CPI again, and my guess, obviously they're going to modify it so it looks lower. And so, any numbers coming out of the BLS showing that inflation has moderated or is headed lower, we'll have to look into their methodology and see exactly what they changed. But anyway, what John is showing us here is that in blue, this is inflation based on the 1980 methodology, and just eyeballing that, I'm going to call it 14%. The BLS, that's in red, they're showing, let's call that 7%. So basically double. So John Williams, based on the 1980 methodology, is double what the BLS is telling us today. They've cut in, the BLS has cut inflation in half with all of their adjustments. So if we were serious about fighting inflation, the number that I hear analysts use is 5 basis points above the inflation rate. You know, if you're serious about fighting inflation, you'd have to be at least 5 points above this 7%, which would make it 12%. So we need 12% interest rates to truly fight inflation at this point, and that's based on the BLS's adjusted numbers. If we use John Williams' number, 14%, add on the 5 points, that takes us to 19% interest rates. So think about 19% interest rates and what that would do to housing, stocks, bonds. It wouldn't be pretty. So anyway, main point. What the Fed is saying, they're not fighting inflation. The reason they keep raising interest rates is because nobody's buying bonds. All of the central banks, well, they haven't totally stepped out of the markets. They can't. For example, France and Italy, nobody's buying their government bonds except the European Central Bank. So if the European Central Bank totally stopped buying bonds, France and Italy would be in a world of hurt. And same thing here in the States. If our central bank wasn't buying our bonds, albeit they do it indirectly because, you know, directly having the central bank buy bonds is you know, it's just obfuscating the fact that you're printing fiat currency. They're just running it through the bonds because that's the game we play here in the States. But anyway, the reason, in my opinion, they are raising interest rates and will continue to raise interest rates is that they're trying to attract bond buyers. China has stopped buying U.S. debt. Most of the foreign countries have stopped buying U.S. debt. Some of the countries, China included, are actually dumping U.S. debt, don't want to have anything to do with it. China's at I think the headline, this was last week, 12-year low in their holdings of U.S. Treasury debt. So the world has lost interest in U.S. bonds. Wonder why that's so. So anyway, Fed's lying to us. They're raising interest rates because they're trying to stop the bond collapse. Remember, we have a global debt collapse happening right now. It's one of the things going on in the big picture, which takes us to this chart. This is the yield on the 10-year Treasury note. We're in the monthly time frame. And a couple of things to notice here. The main feature in this chart is the pink downward sloping channel here. That's a 40-year downtrend in interest rates. They managed to get interest rates almost down to zero. That was April of 2020 before they started heading higher. In December of 21, we have the Evergrande default. That's the Chinese real estate developer, the largest or one of the largest real estate developers in China. They defaulted on $300 billion in debt. And of course, that debt was held throughout the world, Western banks as well as Asian banks. So that was a global event, that default. Interest rates headed higher at that point. And then in March of 2022, we broke through. That's when interest rates broke through the top of this 40-year long downward sloping channel. So clearly at this point, interest rates have broken out. I mean, you know, you just can't argue that point. Interest rates have broken out of their 40-year downtrend. If we look back, when was the last time that we had sustained uptrends in interest rates? Well, we have to go all the way back to 1963, and we see here that is 18 years. So we had an 18-year period where interest rates were rising. And remember, they got up, looks like the 10-year got almost 16%. 30-year fixed rate mortgages were pushing 20%. Imagine what a 20% mortgage loan rate would do to the housing market, decimated. The housing market would be just absolutely decimated at that point. And so anyway, I'm not saying that we've got 18 years of rising interest rates ahead of us, but I'll reiterate what I've said multiple times. Interest rates are heading higher for longer than people are expecting. And so just, tuck that into your planning portfolio and give it some thought. Are you properly positioned or positioned as best you can be for a sustained uptrend in interest rates? Because I believe that's the environment that we are in now. And of course, now let's talk about today's action, because rising interest rates, that's one of the reasons, in my opinion, that the precious metals markets took a hit today. So let's roll on. I got two more debt charts. This is yield on the 1-year bill in the monthly time frame, and this chart, I'm gonna move it up so we encapsulate all of this movement. Something's going on when this chart moves vertically. Bad things are happening in our economy, and clearly that is a vertical move. I believe it's the global debt collapse that kicked off with the default of the $300 billion debt, Evergrande. So anyway, this is an interesting chart. If we look at the 1-year Treasury bill yield on that, we can see a big move today, steadily higher over the last week or so, and then big move today. That's 4%, a 4% move in one day. That's, again, global debt collapse. So rising interest rates, obviously, that's a headwind for the precious metals, because if investors can put their money into the debt markets and make some income, they're less interested in the precious metals, and so that's a headwind. And then of course the US dollar, when it is strong, it tends to show in the precious metals go down. Gold in particular tends to head lower as the US dollar heads higher. And so again, here that was today, the big green bar, that was today's move, pushed decisively through and above this horizontal support resistance zone. And now we can see we're now in the night session. That little blip there, that's the start of the night session, and it's starting at the close of the day. Notice this green bar today, that's an impulsive bar, high energy bar. Price or yield closed essentially at the high of the day. Let's look. Where was the high? High was at 105.6 it looks like, and we closed at 104. Is that right? 105. Anyway, closed very near the high of the day, which is an impulsive bar. So high energy, suggesting that this uptrend is likely to continue almost certainly up to the 200-day moving average at this point. MACD's in bull mode on a buy signal. Energy is very elevated, so almost certainly headed up to the 200-day moving average. Now let's look at the metals. So we can see that big red bar, that's gold today, got whacked. What's that? 1.87%. So big move in gold. And same thing that I just said about impulsive price bars, only in this case it's to the downside. Gold closed very near its low of the day, which of course is bearish. Let me draw in. We've got a potential minor support level, right in there somewhere from this prior low. Perhaps we'll find support there. I wouldn't bet any money on that at this point. MACD's in bear mode, and the very brief buy signal that I was excited about has failed. We're back in on a sell signal. Energy is low, so not a pretty picture in gold. Silver, of course, got whacked similarly. Impulsive bar to the downside. This is the night session, and it's opened at, basically it opened where we closed the day session, and it's heading a little bit lower. Notice that volume rose today on this downward action. That's more bearish indication. You don't want to see volume rising as a vehicle, whatever it is you're looking at. You don't want to see rising volume as it sells off. Here again, the very brief buy signal has failed. We're back on a sell signal in bear mode. Energy is very low. Notice that quite oversold for silver in this time frame. This pink dashed line, that was the prior low in MACD back in mid 22, and so MACD's not bounded, but quite often these prior lows and highs act as boundaries or bumpers, guardrails, however you want to look at it, and we'll get a reversal of price at those levels. So just something to keep an eye on. Mining stocks, they're reacting today to the action in the metals, obviously. Gap down below the 200-day moving average, and then an impulsive move to the downside. We've got this support resistance zone immediately below us. We bounced there, what is that, probably 2 weeks ago, a week and a half ago. Perhaps we'll bounce there again. Looks like we are still on a buy signal in the mining stocks, but rolling over. So, and energy very low. So, wouldn't place any bets. I did buy some Dolly Varden yesterday. I made a small buy yesterday. I won't be buying any more mining stocks until this move shakes out. We see exactly where we're going to go. So let's see. That's the metals and the mining stocks. The equity markets were not. They didn't react favorably to Powell's verbiage today. Clearly rolled over. What's that? 1.5%. Notice that yesterday we'd already gotten a toppy looking doji as price pushed up into that resistance zone, and then today rolled over, pushed not decisively, but pushed through the 50-day moving average, and looks like we closed below that level as well. I'll point out this island reversal, island top. It's sloppy, but it does meet some of the criteria for a island reversal. We gapped into it and we gapped out of it, minor gaps, and so I don't consider that a strong pattern, but it is a potential topping pattern. Sell signal in MACD, energy is low. Similar action in the Dow, lost 1.7% today, rolled over at the 50 and 20-day moving averages. MACD in bear mode on sell signal, energy is low. Like similar in NASDAQ 1.2% loss today, on a sell signal, but still in bull mode. Energy just below mid-range. Island reversal potentially. And that's it for the charts. That's it for me voicing my opinion about the financial markets. And I will talk to you again when I have something more to share. So take care, folks. Talk to you soon.